Hello and welcome to this podcast on the blog individualtrader.net. Just want to talk about market commentary, some of my thoughts. I write pretty exclusively on Seeking Alpha, and I do a lot of trading myself. And I just want to share what I'm up to, and hopefully you can get some value out of this. The first thing I want to turn to is an article I wrote on Chevron recently. Chevron has been going through a difficult period, probably since oil prices collapsed 12 months ago. But Chevron is probably hurting more than other integrated oil companies because it has more emphasis on its upstream activities, especially compared to a company like an Exxon, where an Exxon would have a far superior downstream division. Chevron is more upstream orientated, and it's trading now at about $92. I just think it's a steal at these prices, even though I do think that we have a bear market rally in oil. Oil is probably going back to the lows of March of this year, back to $43 a barrel for crude oil. So Chevron could definitely go into the 80s. But again, its yield is very high here. It depends what type of investor you are. Are you an income investor, or are you a capital gains investor? Chevron's yield at the moment is historically very high at 4.6%. This will go up. It has gone up. I'm not saying the yield will go up, but the payouts will go up, because the company has increased its dividend for the last 28 years. We are due another dividend increase this year. So if you're an income investor, even if this stock drops to $80 a share, $70 a share, which I think will be very brief, your income is going to go up. And that's what a lot of investors need to remember. Are you investing for income? Or are you investing for capital gain? I think you're going to have both out of this stock, definitely in the long term. It has a very low price to book ratio. It's very cheap at the moment. It has some big projects where there have been delays coming on stream very soon, like Gorgon in Australia. And cash flow is going to be freed up. So I wouldn't worry about how the company has been financing its capex and shareholder commitments up to now. It's all going to be short term. So I would definitely advise to invest in a company like Chevron. Definitely, it dominates its industry. If you look at all the fundamentals, its revenues have been increasing, share price action very good, net margins very good. The only thing at the moment that it's not doing well in is its free cash flow metric, and that is only because it has invested heavily in the last 3 to 4 years. So don't be perturbed by that metric. Other things that I want to bring your attention to is yesterday we had a $50 drop in the gold price. Gold is now hovering around $1,100 an ounce. Again, a lot of people think that this may, because of this downturn that we had, we may get a bear market rally out of this before we drop to the $1,000 level. If you look at this over the long term, buying gold or gold mining stocks or silver mining stocks around these levels, should be extremely good investments in the long run. In the long run, buying at 1,100 or 1,000 is not going to make a huge amount of difference. So yeah, we probably will get a bear market rally in gold and silver also before we really flush out the sector by probably hitting $1,000 an ounce, or probably going under it. But again, in the long term, these are going to be fantastic investments. Thirdly, on trading, the volatility in the commodity complex over the last month has a lot of the implied volatility of a lot of stocks and ETFs are way up. So, and we're in earnings season. There's a lot of stocks announcing earnings. So I'm just going to bring your attention to some stocks that I like at the moment, because their implied volatility is very high, and they are very, very oversold. So I would be looking, if you're a trader, I would be looking to be selling puts in some drillers like Seadrill, SDRL, or something like a Noble, NE. Noble is trading at $12.98, Seadrill, SDRL trading at $8.85. These stocks are severely oversold, high implied volatility. You can sell some puts in there, and you will receive nice premium. That would be the play I would be looking at. And if they keep on going down, you could get exercised on your puts, take hold of the stock, or you could roll your puts to the following month. But I think at these levels, I can't see much more pain in this sector, in the drilling sector. In oil, apart from Chevron, Chesapeake, again, very oversold. CHK trading at 10.25, very high implied volatility. Again, I would be looking to sell puts in there, again, just to take advantage of the option premium. You can roll to the next month, again, if you get exercised, or you can take stock. These stocks are trading on the cheap, so if you're only selling one contract, it's only going to cost you $1,000 to take hold of 100 shares. Also, you could wait for earnings. Just watch when these stocks are announcing earnings. The implied volatility should rise into earnings. So it probably would be better if you waited until the day before earnings to sell premium in these stocks, because you're going to get more premium. But apart from that, that would be my podcast. I suppose the last thing I would mention would be silver and silver mining stocks. The whole mining industry in precious metals, again, is under serious pressure, and that's probably where, when gold rallies, that's probably where we're going to see the biggest gains. You have stocks trading at lower valuations than they did 15 years ago when gold was at $300 an ounce. So that gives you an idea of how oversold the mining industry is. It's a safer bet to trade maybe something like a GLD or CLV, but something like HUI, which is the Gold Bugs Index, or GDX, definitely should outperform to the upside once the gold sector bottoms in earnest.